Well, good morning. This is Michael Douville coming to you from beautiful Phoenix, Arizona. Tatum and I are in the super plush studios of West USA, and today is Tuesday, September 29th, 2020. This is another Creating Real Estate Wealth production, and it's our attempt to bring some financial topics that will have some relevance to you and to try and elevate our practices. And of course, this is for investment work. Now, I've been giving back and giving my time to this endeavor because the real estate industry has just been so wonderful to myself and my family. And I'm here to give back, and I'm here to create a real estate money machine for you that's going to give you income to you, your spouse, your kids, your grandkids. Basically, for decades, we can build this money machine and just change your life and make it so much better. And of course, I want to thank West USA for giving me this platform to bring this to you. And they would like you to have not only a really good real estate practice and to be have a really good business, but they'd also like you to develop wealth and develop a retirement plan for yourself and to have these income streams coming to you. And this is my give back to you. So next week, we're going to talk about depreciation. We're going to talk about how to take depreciation, how to calculate depreciation, and what that's going to do for you. And of course, we're going to talk about maybe some tax strategies as well, and that's next Tuesday. If you have any questions, you're welcome to look on the webinar. Tatum will monitor any questions that you have. You can type it. It's in the right-hand corner of your screen. And if we get a chance to answer it during the webinar, we certainly will. If not, I typically get a lot of questions during the week, and I try to address those some of the questions that we have on the Saturday podcast, and we just review a lot of things that we talked about today. So we're gonna continue on. So today's topics is diversification. So it's really an important topic, particularly today when we have a little bit of turmoil in the markets. So diversification, why residential rentals need to be in your portfolio. So how does residential rentals mitigate portfolio risk? How do you use residential rentals to diversify your qualified retirement plan? Now, there's a really good topic. I love that because a lot of people don't realize that we can actually put real estate into qualified plans. And this is just puts an added dimension to your investment scheme. And of course, how does diversifying into residential rentals help time your financial retirement planning? Now, I'm going to be very conscious about your time. This is going to run about 22 to 23 minutes. And we're going to try and get through this. And if you have questions, just let us know. So diversification, how does residential rentals mitigate portfolio risk? Well, let's just talk about portfolio risk. Now, when you're dealing with a portfolio, typically you're dealing with a financial planner. They think there's only two asset classes, and I think that's stocks and bonds. Each one of these classes has their own risk parameters to them. They have their own life. They have their own cycle. So oftentimes they have, sometimes when they're really good time to own stocks, sometimes not such a good time to own stocks, sometimes it's really good time to own bonds. Each one has a different function in. Now, we've noticed so far this year, we've had in March just tremendous turmoil in the stock market. We had precipitous drops in the value of stocks, and of course that gives people really bad nights. They don't sleep well at night. And when you're a baby boomer of my age, if we lose 40% of our portfolio, we no longer feel very wealthy. We're not going to feel like we want to take those cruises and go on vacations and take our sweetheart and learn to cook in France. So we have to be very conscious of how we handle our funds and our portfolio. And we need to be concerned about risk. When everything is just running really good, then risk is really not a concern. However, we run into those time frames like we are in now. We're in one of those time frames where there's turmoil in the marketplace, and you need to really be concerned about preserving your capital. Now, bonds certainly have had a very, very good run for the last 30 years. However, we're down to almost zero on interest rates. Now, they could go a little lower. Europe is certainly negative, but Jay Powell has said that they won't be going negative here in the United States. So if interest rates tick up and start rising, well, this is just terrible, terrible, terrible for the bond market. So by putting a different asset class into your portfolio, like real estate, that actually mitigates a lot of your risk, because real estate often runs cyclically counter to the stock and bond market. So when the stock market has turmoil, as you've noticed in the last 4, 5, or 6 months, that the real estate actually goes up when the stock market starts to have turmoil. It's a counter-cyclical financial asset, and it's not correlated with Wall Street. So this is something really nice to have in your portfolio. So if the stocks start getting in trouble like they did in March, you're going to see your real estate portfolio start picking up. And of course, real estate gives you that stream of income that consistently comes in. And if you need that income coming in, like if you're having turmoil in your portfolio, like we saw, this stream of income from your rentals just mitigates and cushions any downturn that we have. Now, one of the things that you might consider is the fact that there is risk in the bond market. And of course, risk in the bond market we've talked about before. There's credit risk, which means that as the economy softens, a lot of the people that borrowed money in the form of bonds are going to struggle to pay that back because the revenue is not there. The economy has softened, and a lot of business isn't doing as well as it should. Should they default, that's a credit risk, and of course, the bonds can lose tremendous value. The other problem that they have is economic risk, which is interest rates. So if interest rates were to go up, bonds will lose value again. So an awful lot of risk in bonds, which are considered a fairly conservative investment. Now, if you're looking to mitigate risk in your portfolio, you can put real estate in your portfolio to replace those bonds, because they'll give you income, which probably 3 or 4 times what you would earn in the bond market, but they also counterbalance the stock market and move counter-cyclical and add stability to your portfolio. So the immediate benefits of investment returns versus retirement ones is that oftentimes we want to keep real estate outside of our qualified pensions, and you immediately can use that in your everyday life. So if we invest outside of our retirement accounts, you're going to start getting tax benefits, and you're going to get that almighty cash flow, which was really going to make a difference in your life. And we're going to talk about putting some retirement benefits into your portfolio and in your qualified plan as well, because real estate is a very, very compelling investment at the moment. Now, we also want to talk about inflation. So having an asset, a real asset versus a financial asset, keep in mind the stocks and bonds are financial assets. Real estate is a real asset. It's made with real things, with commodities. It's made with aluminum and asphalt and copper and lumber, concrete. All these things are real assets. During an inflationary period, as those products go up, those things that are made from those products are also going to go up, and it provides risk mitigation in the fact that as inflation comes into the economy, real assets will ride that inflationary wave, and of course, so will the rent. So what a great risk mitigation real estate is, again, to have in your portfolio. And you can have it inside your qualified plan or outside your qualified plan. And of course, both ways has been very, very good, because here again, we have cycles. So the stock market is finishing its cycle. You can see the turmoil. Now there's a question, are we going to have a V-shaped recovery or a W-shaped recovery? We're going to know here in the next couple months. whatever it is, we will be recovered in 6 to 9 months, and things will start to be recovering. Recovered is probably another 18 months to 24 months away, but we could very well be on the path to recovery, which is what everybody's looking to do. Or if we put this into our financial assets, we can put this into our IRAs. And let's just talk about that for just a second. How do you use residential rentals to diversify your retirement plans? Well, real estate is a very, very compelling asset class right now. As we were talking about the cycles, stocks are finishing their cycle and they're kind of a little bit of a turmoil. Bonds are certainly at the end of theirs because we're at 5,000-year lows on interest rates. Odds of them going up are a lot higher than them going down. So you have to assume that we're at the end of that 35 years of cycle. So oftentimes you see a bond cycle is 70 years of an interest rate cycle, 35 years of rising interest rates, 35 years of reducing, lowering interest rates. And of course, since 1982, we've had 35 years. It takes us to 2017. So we are at that bottoming process right now. Rising interest rates is a concern. So that cycle is ending. Real estate is not. So real estate is a very, very compelling investment, whether you're inside of a qualified plan or not. Now, if you want to put it inside your qualified plan, we just need to convert it to a self-directed IRA. Lots and lots of companies that are dedicated to doing that. It allows you to make those decisions. So if you go to some of the big major houses, again, they think there's stocks and bonds. But if you go to a self-directed IRA, you can have stocks, bonds, coins, you can lend money, you can buy real estate. And of course, this just gives you all kinds of diversifications. So when we run into turmoil, we want to have that diversification in our portfolios, inside and outside, wherever you have your funds, with which to mitigate risk, because we do not want to experience 40, 50, 60% loss in any of our portfolios. Putting real estate in is going to mitigate a lot of that risk. Now, once you get it into if you have your real estate in a self-directed IRA, everything becomes tax deferred. So if you buy a piece of property in the self-directed IRA, if you buy for $200,000 and it goes to $400,000, you can literally sell it, not trade like we do outside. You can literally sell that piece of property within your self-directed IRA, retain the entire $200,000 in capital gains, and pay no tax on it. Now, it also will have no tax buildup on the income stream that you're going to receive on your real estate. Keep in mind, why are we buying this real estate? We're buying this real estate to make ourselves rich, and we want to create wealth, but we also want to get the income, so it's going to give us reserves, and it's there to mitigate risk for ourselves and have income coming in should there be an economic downturn like now. So if your business is impacted, having rental income coming in just comforts and softens whatever you're not getting. And this will build up inside your IRA tax-free. So you're going to just get the full advantage of the entire income stream. There's no tax on appreciation. And let's just think about flipping. So if you want to flip a property, you can flip it inside your IRA, make all that income, and instead of getting an ordinary income hit for paying 25, 30, 35% of your profits, you get to keep the entire amount. Will stay within your IRA and not be taxed. So you get a really, really good buildup. Now, real estate is heading into its top cycle. So we have 3 or 4 years of very, very good real estate activity, and you can really, really get a lot of investment returns on these, and putting them into your IRA is just an absolutely terrific way to do this. So how does diversifying into residential rentals help me time my financial retirement planning? What a great question. Now we can do this by just taking a principal reduction and timing it. You can go to the internet, put in how much mortgages you have, what the interest rate of that mortgage is. It's going to come out and tell you what the payment would be based on 30 years. And you can say, well, what if I put an extra $100 down a month? How long will it take to pay off? What if I put $200? Last week, we talked about the principal reduction strategies, and you can see it in black and white. You can play with it. You can decide, if I want to retire in 10 years, how much more principal do I need to do to put down on these properties to have them paid off? You can schedule your increase in wealth courtesy of someone else's money. We can just schedule it and know that in 10 years, these properties are going to be free and clear. If you're 30 and you want to retire at 50, we can do it in 20 years. It's also a long-term investment. I don't know how many times I sit down with clients and with agents to have them tell me that they just took a profit on their portfolio. And here's the problem when you're dealing with stocks and bonds, because they're so liquid now. Being liquid can be a very, very good benefit, but also it's kind of a curse, because we often feel like we need to trade them instead of letting them work. Now, real estate is by its nature a very illiquid investment and a long-term investment. So when I sit down with clients, we talk about buying for 5 years minimum. So we buy it and really forget it. We enjoy the benefits of it. We take the tax benefits of it. We take all that rent coming off it. We take all that income coming off it. And we just forget that we have any appreciation for a minimum of 5 years. And then we review, because it's a really, really long term. It's going to grow on you. Remember, there's 6 ways we make money in real estate, and we want to season that investment. And here's probably one of the best things about diversifying into residential rentals. They run counter-cyclical to the economy. They're often recession resistant. When we start talking about particularly our conservative investments that we're dealing with, we're talking about single-family homes. Typically, we're talking about starter homes, so virtually everybody can afford one of these. They can all rent them. And maybe we diversify and get a little higher, because, again, we want to diversify that portfolio. But they run in recession. They're recession resistant because people need a place to live. And I'm going to tell you, having a roof over your house, when you have a family, that's one of the prime things that they're going to do. They're going to make sure that they pay the rent. Now, I want to talk briefly also about diversifying your real estate portfolio. Now, keep in mind, we talk about their separate asset classes, and we want to look at this as an integrated asset class approach. In other words, we realize the fact that we don't have all our eggs in one basket. If we're in the real estate business, we probably have a lot of our assets in real estate, but we may also have stocks and bonds, pensions, annuities, and that's part of our total picture. Now, when we're talking about our real estate portfolio, so if we have 10 or 15 or 20 properties in our portfolio, we need to pay attention to diversifying that portfolio as well. Now, when you find a really good deal in a neighborhood, we often talk about the universe of homes that we buy our properties in. We don't want to overflow into one neighborhood where we have all our properties in one neighborhood. We often look at 10 or 15 different universes of home, so we can diversify our portfolio across different areas of the city. And of course, we want to look at the fact that we don't want to go just in starter homes. Maybe you want to look at a couple condos. Maybe you want to look at maybe the second plateau. Maybe you want to look at a 3-bedroom or a 4-bedroom house. And you have some diversification within your real estate portfolio as well. Now, you know, I always offer an hour free to come in and see me. I'm more than happy to brainstorm with you if you want to bring your portfolio, and we'll take a look at it, see if there's any holes in the portfolio that can be filled. And I'm more than happy to do this. You guys all know this. This isn't like we're doing something that's so magical that you can't do it. It's pretty easy. We have our forums. We can generally figure this out pretty doggone quickly for you. So I'm going to try and wrap up here and talk about next week. So next week, we're going to talk about depreciation. Now, depreciation is one of the 6 benefits we get when we buy a piece of property. we need to really pay attention to our depreciation. We can also talk about how to avoid taxes. How would you like to be able to save $25,000, $30,000, $35,000 on your taxes each and every year? That's like having a part-time job. If you can reduce your tax bite, you can easily do this. So here again, we're going to talk about that next week. We're going to talk about some of the formulas. And of course, when we talk about the formulas, we always want you to talk to your financial advisor to just run it by. So when you're talking about taxes, you probably want to talk to your CPA or your tax advisor and just be sure that what we talk about is right for you. So I'm going to be trying to be very, very cognizant of your time. I said about 22 minutes, so we're running into that time. Now, we always give you a flyer at the end. You're welcome to send into Creating Wealth at West USA if you want to request this flyer. It's kind of a memory jogger. It'll go over some of the things we talked about today. You're also welcome if we have a very, very soon, we're going to have the workshop coming up, and I'd like to do a beta test on that. So we're going to be asking people if they would like to come in and be participants in that. And if you would be interested in it, you can email to Creating Wealth at West USA. If you have any questions that came up or if you after the program, you're welcome to send us to Creating Wealth at West USA. If you feel like you need to talk to me, I'm at 602-942-4200. You're welcome to give me a call, and we'll certainly make contact. And if you'd like to get involved with us at all, just Creating Wealth at westusa.com. Now, Tatum is going to go ahead and have the YouTube probably done by this afternoon, and you're welcome to send that out to your clients. If there's anything we can do for you, just let us know. And always, my very, very best to you. Bye-bye now.